Getting a mortgage might seem daunting if you're your own boss, but getting the knowledge up front you need and preparing is totally achievable as long as you're prepared up front and you know what you're getting into. Hello, my name is Kevin Brierton, certified mortgage planning specialist with Neo Home Loans and the Brierton team. And today we're going to demystify the mortgage process for self-employed individuals just like you. For traditional employees, mortgage qualification often involves W-2s or maybe tax returns, pay stubs, but you as a self-employed entrepreneur, the path is a little bit different. It really involves a few other things, and let's kind of jump in. The key with this is your application is you have to prove you're self-employed. Timeline, how long you've been self-employed is a big piece of the puzzle. Most lenders look for at least 2 years in the current business. However, don't lose hope if you're newly self-employed, because some lenders, and there were some lenders we could place with, accept 1 year self-employed, but we have to combine that with something else that was going on. Education or previous employment. So it depends on what your history is. So make sure you have your nice timeline, your resume, and everything set out. Now, let's talk about the income documentation. There's standard is a 2-year tax return history. But if that's not feasible based on your timeline, don't worry. Some lenders allow bank statements to assess your income. The lender's program could be unique, and there's a bunch of different programs out there. So it's really vital to discuss them up front. I always recommend looking at tax returns first and then looking at the bank statements second, to make sure you don't miss an opportunity to get the best deal. Also, let's explore a few different ways and different types of income that may be considered for a mortgage. So this is including but not limited to, business ownership income if you own a business or own part of a business, freelance income, contract work, think 1099 income. You'll be designated as self-employed, even though you probably don't necessarily see yourself as the owner, but you would be designated as self-employed. Seasonal income, sometimes seasonal income will fall into that gap, side gigs, things like that. Now, these income sources can be assessed individually or in conjunction with your primary income. So think about having a primary job and then also having a side gig. Sometimes you can use it if you have the history there. If you're trying to qualify and you need additional income, make sure you provide your additional sources of income to your mortgage planner and lender to be able to plan that out. So even unemployment income might be considered. So seasonal workers, this is common where if they take some time off due to weather or whatever, seasonal workers might get every year, they may get unemployment for a period of time. And if that happens, we can actually use the unemployment income in qualifying as long as you can consistently show it and that's a seasonal working job. For ongoing unemployment or income verification, lenders generally want to see the stability. We want to see as lenders the likelihood it's going to continue for at least 3 years post-closing. Nothing's guaranteed, usually for 3 years, but it is important to know a few things with this. It can't end. So let's say you have a contract and your job is ending with the next day, X time. That could present an issue possibly. So talk to your lender about it. Also, declining income. So if your income's trending down, that could be a real struggle in getting qualified and getting approved for the loan. So just make sure you map it out. If there's a reason for the decline, make sure you write a letter for that or you explain that to your lending partner. Figure out how to work around that or what the situation was. Very, very important. Underwriting process for self-employed individuals involve a detailed analysis. So lenders add back in certain deductions like depreciation or to your taxable income. So just because you see your taxable income, or there's a few things here, if you see your income, I've literally talked to thousands of people about their home loan situation, and a lot of times self-employed will give us the gross amount. The business may make $300,000, but then they have $100,000 of write-offs, true expenses, whether it's supplies or office space or whatever. Really need to look at after write-off expenses, but like I just mentioned, there's things you can add back in. Sometimes you could add back in mileage, mention depreciation. So it's important to go through all your tax returns with your lender and have them pre-underwrite your loan than just going off the income that you think it is. Even if somebody tells you no, because maybe you used the wrong income, maybe they could squeeze out more income. So this really could be a big impact on your loan qualification. The modern bank statement programs, though, also are out there, also known as non-qualified mortgages. And they're non-qualified because they don't fit the traditional guidelines. So when you go into non-qualified, there's extra disclosures and there's extra process there. They may not be bought by the big entities like Fannie Mae and Freddie Mac, but they're great alternatives. They may have a slightly higher rate because they're a little bit more risky, but they could really give a buyer or or whether it's a client of yours, if you're a realtor watching, an opportunity to buy a house or refinance when you may not be able to. So a lender in that case for a bank statement program would really want to look at 2 years tax returns. Some of them aren't required, but then they're going to look at business licenses, profit and loss statement, balance sheet, CPA. The bank statement though is important because you're either going to use 12 months or 24 months. So I just mentioned some normal bank statement or normal documents you'll need for a normal loan. Like I said earlier, it's important to look at all of it in the bank statement program just to make sure you go with the right option. And if you're a sole writer, business tax returns might not be necessary because your business may be filed inside of your personal returns, or if you have stable income for a period of time, generally 5 years, you may only have to provide 1 year tax return, but it all depends on your timeline and you have to show a history. You have to have really good credit as well, typically, to be able to get the 1 year tax relief benefit on your documents. Addressing income inconsistencies head on. This is important. If your income is inconsistent in any way, make sure you explain why. Seasonal, that might be why. We're here in Arizona, so obviously summertime can change things. Think of it if somebody's self-employed at a restaurant, maybe their income's up or down at different times. But lenders will understand that businesses can fluctuate, so be ready to explain those significant changes. It's super important. And then being self-employed doesn't always mean full ownership. So if you own more than 25% of the business, or you're primarily a 1099 income, you're likely considered self-employed in the eyes of the lender. One thing that we see too is, we get this a lot, if you're 100% owner of the business or more than 25% owner and you get a W-2, a lot of times we'll ask, are you self-employed or employed? And the family will say they're employed, which is true, but they're employed by themselves. We have to understand, and we'll come out in underwriting, that they own the business that they're employed by, but you still have to designate it as self-employed. It doesn't mean we can't use a W-2 income. We have to designate it as self-employed and go off the self-employed guidelines with their tax returns. Because think about, if somebody gets a W-2 income, they could pay themselves a W-2, but the business could be losing money. So that could be a problem for the loan and the lender, and how viable the loan is long term. Joint mortgage applications, whether one partner is self-employed, is also possible. Lenders will focus solely on the traditional employed income if the self-employment is irregular. So if you have two people on it, lenders will generally try to go with the traditional income if the income doesn't work for self-employed. But if you can do both, it's even better. So planning's key. Collaborating with a true mortgage planner, somebody that does the planning, has experience and reviews behind him, is super important. Somebody that worked with conjunction with an accountant to help navigate the journey as well. Lenders are not accountants, so if somebody's trying, obviously we're talking about this stuff, but just know if the lender gives you hard facts on this stuff, you really want to get a second opinion. So a lot of times the lenders are not accountants in most cases. You always want to keep your accountant in the loop as well, and a good lender will work in conjunction with them. So as a self-employed individual, you have access to the same mortgage programs, the same interest rates as others. The right lender, the right mortgage planner will help you with the knowledge and options that are really right for your unique situation. Thank you so much for watching. Hope this information is valuable. If you liked it, please please share, and please comment on the videos. I'm really excited to continue to educate people with this and help more families into houses. My name's Kevin Brierton, Certified Mortgage Planning Specialist with Neo Home Loans and the Kevin Brierton team. I'm here to help you achieve your home goals and dreams. And if you want to schedule a mortgage strategy session, go to mortgagestrategycall.com. And it's going to go on the screen right now. Again, that's mortgagestrategycall.com. And we'd be honored to help. Schedule a call. We'll jump into action, either myself or somebody from my team, and we'll spend about 15 minutes with you, 20 minutes, maybe sometimes an hour. And we don't have to pull credit right away. Our goal with that call is really to understand your needs, answer your questions, figure out what a good game plan is, the next steps. So we're excited about helping you. Thanks again for watching. We'll catch you on the next one, and we'll talk to you soon. Thanks again.